Hi, my name is Stacey Mankoff. I am the managing principal of the Mankoff Company, founder of After the Bell events, and presenter here at the Bellringer, which, as you know, is the offshoot of our After the Bell events, which have been on pause due to the global situation. But we are extremely hopeful that this will change in the fall. And I am delighted to welcome Charlie Dreifus to today's Bellringer. Now, our discussion today will be a view on the markets and the rise of the small caps. And Charlie is the portfolio manager and managing director for Royce Investment Partners, where he manages the firm's small cap special equity strategy. Charlie has over 50 years of experience in the investment industry, and in 2008, he was named Morningstar's Domestic Stock Fund Manager of the Year. And I am delighted to welcome you, Charlie, to this edition of the Bellringer.
Thank you, Stacey. I'm delighted to be here.
Great. Was there anything else you'd like to add?
No, I guess as I tell young students of the market when I travel around, my years in the market mean that I'm old, and whatever exams they have to take these days, I couldn't pass. It's good that I got into the business when I did.
Well, you know, they say everything's old is new again, and you couldn't say more with what's going on right now. And I'd love to first get your take on the current state of the market, especially with the looming impact of this new stimulus package, which they hope to get in place by mid-March.
Good question, Stacey. So I'm known for not mincing words.
Right.
The market is in a bubble. Values are high. At best, you can say they're okay, but forward returns are going to be lower. We borrowed from the future. The economy is going to be strong. It's going to be even stronger because of the initial stimulus, additional stimulus program being spoken about now, plus the infrastructure to whatever degree we get that later in the year. But the economy is set up. As we reopen, there's huge pent-up demand to travel, to go to sporting events, to do all kinds of things. The issue is how sustainable that is after the initial pop, but it's certainly going to be at higher levels than we've experienced.
Right.
So the economy is going to be stronger. There's a huge amount of personal savings. What hasn't necessarily hit consumer headlines, although the financial community knows it well, is that the savings rate that normally is in the 5 to 10% range has hovered around 20%. That partly was due to fears people had about their lives, about their jobs.
Right.
People tend, plus the fact that you couldn't spend it. I mean, you couldn't travel, you couldn't. Right. So we're set up for a very strong second half of the year, barring a new black swan, meaning
a new variant or something like that, that the vaccines don't work on.
I think people have sort of, to some degree, factored in because you see what's going on in Brazil and some other places.
Right.
I'm more about political tensions, whether it's again with China or there's obviously activity going on in the Middle East. And, we haven't had that kind of depressant on the market for a while, and that could be the surprise. The other thing that, of course, is in motion because of the strong economy is, higher interest rates and higher inflation. Companies, as you mentioned, Stacey, I have been investing in small caps in terms of mutual funds for over 40 years now, and speak to a lot of managements, companies we own and companies I learned to rely on to get a good sense of what's going on in the economy.
Mhm.
And there's incredible tightness in terms of availability of materials.
Mhm.
Some of this got heightened, obviously, by the bad weather episode we recently had, but it was rising even before then. Inventories were worked down very dramatically
Mhm.
during the pandemic.
Mhm.
The whole chain from manufacturers to the ultimate user has very low inventories. So should the economy continue to improve, which is my base case, I think it will,
Mhm.
that we're going to see shortages, we're going to see price increases, we're seeing it already in terms of labor cost increases.
Mhm.
There's huge increases in transportation, particularly for things coming in from offshore. Containers are in very scarce supply.
Mhm.
Uh, Prices are way up on these containers for sending stuff. And then in places like Long Beach, California,
Mhm.
uh, the ships can't dock. There's a huge queue outside in the ocean of
Mhm.
ships waiting to get the cargo unloaded.
Sure.
So there are these structural things, but all in all speaks to a stronger economy
Mhm.
with higher inflation,
Mhm.
higher interest rates. Higher interest rates are a depressant on price earnings ratios, multiples on stocks.
Sure. Yeah.
And in general, and very specifically, and you're seeing that in the marketplace, it's most hurtful, damaging to growth stocks, because growth stocks are valued on the present value of some future stream of
Mhm.
earnings, cash flow, dividends, whatever. And the way you present value that, bring it to the current value, is use the current interest rates.
Mhm.
And as interest rates rise, the present value gets reduced. So that is clearly happening in the marketplace. And we've had a great deal of interest in areas that were for over 10 years relegated to the trash can,
Mhm.
cyclicals and value stocks, particularly in the small cap area, small cap.
I was going to ask you about that. So, can you name, like, either the industry or some stocks that you're talking about, or something little, give people a little more specific idea?
Well, yes, I certainly can. I'm going to refer to my printout of names
Uh-huh.
just to um, perhaps pick the ones that have already exhibited substantial moves, but are the types that, when the economy continues to do well, should also continue to benefit. One example is a company called Huntsman,
Mhm.
uh, which is based out of Houston,
Mhm.
chemical company. It used to be a commodity chemical company. It used to have an awful lot of debt.
Mm.
Therefore, it was junk bonds
Mhm. Mhm.
issue. Uh,
Ah, the Milliken days. Yep.
but they have done a metamorphosis that is not fully appreciated in the marketplace. The son of the founder runs it. He's somewhere between 55 and 60. He's not a youngster, but he has a lot of experience, but very different than his dad, who was very acquisition minded and added tons of debt. The current Huntsman, Peter Huntsman,
Mhm.
has divested of a lot of the commodity
Mhm.
kept operations and gotten more into specialty chemicals, and in areas where capacity has left.
Mhm.
Seeing that, one of the themes that also occurred intensified in the pandemic, but was happening before, is despite low interest rates, which of course worked against this happening,
Mhm.
was the closure of capacity.
Mm.
Demand dwindled and capacity left.
Right.
So when demand for chemicals that Huntsman makes increases, they have more pricing power because of the activities regarding getting rid of operations. They
Mhm.
now investment grade bond rating
Mhm.
at cash. It's a very different company. So, and the stock reflects it. The stock, from the low of last year, doubled essentially,
Mhm.
which is common among um, small cap cyclical value.
Mhm.
Uh, there's been a reversion. We had be, starting with the great financial crisis in 2008-9
Mhm.
until now,
Mhm.
despite the actions of central bankers around the world, they created a great deal of liquidity, but it had virtually no impact on the real economy. What it did
Mhm.
was drive up asset prices, whether it was stocks, art, until the pandemic, commercial real estate.
Right.
And, money will find a place to go, but if the real economy doesn't require it, it goes into financial assets.
Mhm.
But that same issue, the economy was not really showing any signs of improvement, made people focus on growth stocks because they wanted to get earnings growth.
Right. That's what I wanted to ask you. Sorry to interrupt. But 2020 was such a banner year for small caps. Um, do you think 2021 will continue on that same trajectory as 2020?
As long as the economy continues to move forward as it has, the investors do not have to pay up for growth
Mm-hmm.
if you can buy it
Mm-hmm.
more inexpensively.
Mm-hmm.
So if they succeed, and that's what's intriguing, particularly about the infrastructure program. Uh, all of the stimulus that's occurred in the States so far
Right.
in income substitution.
Mm-hmm.
It's allowed people to pay their rents, to buy food, to
Mm-hmm.
house themselves, so forth. But it's had virtually no impact on the economy. Infrastructure spending, be it roads,
Mm-hmm.
broadband enhancements,
Mm-hmm.
it's all
Yeah.
of which, interestingly enough, does have long-term economic benefits in terms of increased productivity for the
Mm-hmm.
state, makes the US more competitive in the world markets.
Mm-hmm.
So there is a payoff down the road, but there
Mm-hmm.
are now, but those expenditures have what are known as multiplier effects. When you build a road, you all of a sudden not only have these laborers on the highways, but you're buying cement, you're buying road signs.
There's a trickle up effect, I should say.
Right. It's in economics, it's referred to as a multiplier.
Right.
And
Now, the last administration came in with the promise of investing in infrastructure, and it didn't happen in the level. Do you feel more optimistic with this uh, administration that there will be a real investment into it?
uh, yes, although the way it's been proposed, it's going to be over many, many years.
Mm-hmm.
Um, and the issue, it's interesting. People are willing to spend without regard to where the money comes from. for those income substitutions. But when it comes to infrastructure, they're concerned about how do you finance it.
Well, yeah, because two infrastructure plans were pulled out of the present stimulus package. One was in California, one was in New York. So that's why I'm curious, or that there seems to be some resistance.
Well, there's momentum for it, and
Mhm.
I think people recognize the shortcomings of, while needed, nonetheless, the
Mhm.
shortcomings on really getting us out of our, pandemic, or for that matter, pre-pandemic. Again, going back to
Right.
since the financial crisis,
Mhm.
uh, absence of growth. You can create all the money in the world. If it doesn't get out in the economy, there's something known as velocity of money, which
Yes.
just how
Mhm.
how often it turns.
Mhm.
Okay,
Mhm.
simplest version, and the money that's been created has not turned. The velocity of money has declined. Borrowings at financial institutions, mainly banks, have not been sought after. So what you want is an economy strong enough where money gets out in circulation, people borrow, velocity of money goes up.
Mhm.
And nonetheless, what you're raising, Stacey, is the ultimate question. How do we pay for it?
Mhm.
Is it taxes, on whom,
Mhm.
to agree?
Mhm.
And that remains, and that's going to be the fight, obviously. I'm convinced we're going to get some form of infrastructure spending.
Okay.
That's not the issue. The magnitude is an issue, and that's a function of how they plan on financing it. There's a whole new application. The thought's been around for a while, but
Mhm.
it's MMT, monetary theory.
Mhm.
A reserve currency, meaning a country where the world uses as its common currency, which
Mhm.
the dollar enjoys, but people should not forget that 125 years ago, England enjoyed. The pound was the dollar of today.
Right.
The pound shriveled
Mhm.
and lost its potency.
Mhm.
Um, so, but a reserve currency has a lot of freedom in the sense you can issue, people will own your debt. And so you do have the ability of issuing a lot of debt, but people on both sides of the aisle, this is not only a Republican issue, there are many thoughtful Democrats who are concerned about, how do we ever pay this stuff off? And what are the consequences? What are we leaving for, future generations in terms
Right.
of burden? And do we become, particularly with China being as strong, and because it's a controlled economy, more nimble, frankly, than we are.
Mhm.
What's to prevent the US being the British pound of 125 years ago and China becoming the reserve currency?
That I can't tell you. If I could tell you, I,
Right.
I retire, but
That's the issue in terms of how do you frame
right.
the likelihood and, more importantly, the magnitude
Mhm.
of infrastructure spending. The likelihood is very high. The magnitude is a little less certain,
Right.
because of the funding issue.
Right. Well, I'd like, and I really appreciate your perspective on this. I'd like to wrap up our conversation, and as everyone knows who watches this, this gives everybody a taste. They can always reach out to you through the Bellringer email and all of that. But I'd like to wrap this up with your outlook for the next several years. Are you bullish, bearish? What do you think?
Well, I've lived through many bubbles.
Mhm.
I was a nerd in high school. many think I still am.
Before the term was coined, right, Charlie?
Because in high school in the late 50s,
Uh-huh.
other students after school ended would be in the schoolyard playing basketball. I would be at the public library researching stocks. I was literally day trading before the term existed.
Uh-huh.
Before we had iPhones.
Uh-huh.
I had a hall pass from my Brooklyn high school guidance counselor that
Uh-huh.
used a public phone because I would be calling my broker twice a day trading. And that, in the late 50s, we had the Sputnik bubble, anything related to space.
Mhm.
Then in 1972, 74, we had the Nifty 50, much like the FANG stocks
Yes.
were recent
Mhm.
years. An
Right.
enormous group of stocks that could do no harm. You could overpay, the thought was,
Uh-huh.
because these companies will grow forever at 15%.
Right.
Ergo, in this list, this basket of 50,
Mhm.
Eastman Kodak, Polaroid, J.C. Penney, Sears Roebuck, many company, Avon, that had, if not lost everything, lost nearly everything.
Yes.
The
Mhm.
other hand, so was Johnson and Johnson and Triple M, and
Mhm.
they endured and sustained themselves.
Right.
The point is, people get overly enthusiastic, and then of course we had the dot-com bubble of 2000, and there are so many manifestations. Um, you know, I've seen this movie before. It doesn't end well. The whole business of these special purpose activity companies, SPACs,
Mhm.
and what's gone on in terms of the speculation, this whole Robin Hood movement in
Mhm.
GameStop,
GameStop. Yep.
not a sign of the beginning of a market move.
Mhm.
These are all telltale signs, plus traditional valuation metrics. And you can choose it. Every single one of these valuation metrics that have been time tested. And
Mhm.
yet, adjusting for the ones that have no relevance anymore because something that was relevant in 1929 at the peak, we have a very different economy.
Mhm.
But, relevant to 2000, yes, we've made improvements, but that was a tech economy as well.
Mhm.
Many measures surpass now what we saw in the dot-com bubble of 2000.
Mhm.
At best, we're gonna get a correction. The correction can happen two ways. We're either going to get the rather traditional correction, which is the market goes down, 20, 30%.
Mhm.
And rather than snapping back immediately like we've been used to, it takes a while. And it can take years for it to gradually improve. The other correction, which is less frequent but happens as well, is that the market does nothing for a while, doesn't go down, but it treads water as earnings increase to justify the
Mhm.
level of valuation. Either way, you have to assume, you have to be cautious.
Mhm.
This is not a time to go on leverage on margin.
Right.
This is a time you make money by losing less. You have to try to prevent big losses if possible,
Mhm.
so that you have staying power. But forward returns are going to be lower. We've over-earned. And the market has a way of getting back to trend line. Reversion to the mean in the stock is a very, very powerful force. Because we're dealing with psychology and sentiment,
Mhm.
people, there's sort of a manic depressive nature to the stock market.
Mm.
You rarely are at equilibrium. People are usually either manic or depressed. We're in a manic phase.
Charlie, that's great insight. I've not heard the market described like that before, but I will definitely use that term in the future. I thank you so much for your insight. And for everyone, thank you for listening. Thank you, Charlie. We're going to be taking a few weeks hiatus. And so this is a great way to wrap up our early 2021. And I look forward to sharing more insights throughout the rest of the year. Thank you all.
Thank you, Stacey. Are we off air now?